You know that feeling you get when the headlines about the economy feel a bit, well, all over the place. One day it's market highs, the next it's whispers of slowdowns.
Yeah, conflicting signals seem to be the norm lately.
Exactly. Maybe you're hearing about potential recessions or seeing headlines about market volatility or just wondering how these massive global forces like AI or climate change actually plug into the whole economic picture.
It's a lot to process.
Are we headed for a downturn? And, if so, when might it hit? What would actually cause it?
That hum of uncertainty is very real. Navigating the economic landscape right now feels particularly complex,
Mhm.
and understanding why requires going beyond just the daily news cycle.
Definitely need a deeper look.
It requires a deep look at the underlying forces and, crucially, the signals the experts are actually watching.
Absolutely. And that's exactly our mission today. We're diving deep into a stack of serious research and outlooks from some of the most respected global institutions out there.
We're talking the World Bank, the International Monetary Fund, the IMF.
The OECD, alongside analyses from major private firms like JP Morgan and Morgan Stanley, and key signals from places like the New York Fed. So a really broad base.
These sources give us a comprehensive multi-angle view of the global and U.S. economic horizon, specifically stretching out from 2025 towards 2030.
And our goal isn't just to read off forecasts, right?
Not at all. It's to unpack the analyses, understand the why behind them, identify the key indicators that matter most, and figure out what this complex picture could potentially mean.
For the global economy, for different regions, specific industries, maybe?
And ultimately, for you listening right now,
Yeah.
how does this filter down?
Think of us as your guides through this, well, intricate territory. We're here to help you cut through the noise, pull out the essential nuggets of knowledge from these expert deep dives.
And equip you to be genuinely well-informed about the economic path ahead.
Okay, so where do we start? Before we can even talk about the probability of a recession,
Mhm.
we need to nail down the basics, right?
Exactly. What are we even talking about? What exactly is a recession? And importantly, how do the experts define it? Because it's not always straightforward.
Right, because it's definitely more than just a subjective feeling that things are tough out there. At its core, the economy naturally ebbs and flows, moves and cycles.
It's a business cycle, yeah.
You have periods of expansion where things are generally growing, and then periods of contraction. And a recession is one of those significant contraction phases.
Precisely.
Mm.
These contractions, or downturns, they don't just happen randomly. They typically stem from what economists call aggregate shocks.
Aggregate shocks. Okay, sounds big.
They are
Yeah.
significant economy-wide disruptions.
Is that a shock to the economy's ability to produce things, or more like a shock to people's willingness to buy things? Or both?
It can be either or both. An aggregate supply shock disrupts the economy's overall ability to produce goods and services.
Like a natural disaster taking out infrastructure,
Mhm.
or a geopolitical event cutting off oil supplies.
Exactly. Or the kind of supply chain disruptions we saw during the pandemic.
Mhm.
And crucially, with a supply shock, you tend to see lower output and higher prices.
Ah, because fewer goods are available, but people might still want them.
Right. That's a typical pattern. Now, on the flip side, an aggregate demand shock hits the overall willingness of consumers and businesses to spend and invest.
Okay, so like maybe everyone suddenly gets nervous about their jobs and stops buying big ticket items.
That's a classic example. Or maybe a financial crisis makes it really hard for businesses to get loans to expand.
Got it.
And with a demand shock, you typically get lower output, but also lower prices
Mhm.
because there's just less appetite to buy things.
Mm.
Businesses might cut production, maybe even lower prices to clear inventory.
So understanding that difference, supply shocks meaning lower output, higher prices, demand shocks meaning lower output, lower prices, that helps frame what kind of pressure we're seeing.
It does. It gives you a lens to analyze the situation.
Okay, so it's a broad contraction caused by a big shock or shocks. But the source material makes it really clear that actually defining when you're officially in a recession isn't always cut and dried. It's not just waiting for a specific number, is it?
That's a really important point, especially when you're trying to interpret forecasts. In the United States, the job of officially dating recessions falls to a private, nonprofit research organization called the National Bureau of Economic Research, or NBER.
The NBER, right?
And they deliberately don't stick to that simple rule of thumb. Most people know 2 consecutive quarters of negative real gross domestic product, or GDP growth.
Wait, seriously, the 2 quarters GDP rule isn't the official U.S. definition? I thought that was it.
It's a common shorthand, and honestly, it often holds true. But no, it's not the NBER's official definition. They define a recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months.
Okay. Significant decline spread across the economy, lasts more than a few months. What does that mean in practice?
They look at three broad criteria.
Mm-hmm.
The depth of the decline. How severe is it? The diffusion, how widespread it. Is it just one sector, or is it hitting many different industries and regions?
Okay, diffusion.
And its duration, how long does it last?
So how deep, how wide, how long? Makes sense.
Right. And their process is flexible. This is key. A very severe, very widespread drop one that hits many sectors hard all at once can be enough for them to declare a recession, even if it's actually quite brief.
Ah, like the COVID-19 recession in 2020. That was incredibly sharp and hit almost everything, but wasn't it only a couple of months long?
Exactly. That's the prime example from the source material. Because the depth and diffusion were so extreme, its brevity didn't stop the NBER from officially dating it as a recession.
So that flexibility means a future downturn might not fit the 2-quarters rule either. Makes it harder to spot in real time.
It does. And there's also the lag issue. The NBER typically declares a recession after it has started, sometimes months into it, occasionally even after it's technically over, looking back.
Which means, you could be feeling the pain of a downturn, layoffs happening, businesses struggling without any official confirmation for quite some time.
Precisely. That lag can definitely complicate policy responses and, frankly, individual planning.
What about on a global scale, then? Is there a single world body, like a global NBER, that declares global recessions?
There isn't one single statutory body for the whole world, no. However, the criteria used by major international organizations like the IMF and the World Bank are highly influential in identifying these global downturns.
Okay, so what do they look for? Similar idea to the NBER.
Similar concept, but adapted for the global scale. Like the NBER, they don't have a single rigid definition or even a minimum duration requirement.
So how do they assess if the whole world is in recession?
They generally look for a decrease in per capita global GDP. That's GDP per person worldwide.
Okay, per capita, not just total.
Right. And alongside that, they look for a widespread weakening across a broad set of other key macroeconomic indicators globally. Things like declining global trade volumes, reduced capital flows between countries, weakening employment trends worldwide, falling industrial production, decreased energy consumption, and declines in per capita consumption and investment. Basically, a synchronized global slowdown.
And they use that PCP thing too, right? Purchasing power parity?
Yes. They often use purchasing power parity, PPP, when analyzing global GDP. It adjusts for differences in price levels across countries, which helps make comparisons of economic output more meaningful.
Makes sense. So, based on those criteria, how many global recessions have they identified recently?
Well, before 2020, the IMF had identified 4 global recessions since the end of World War II, 1975, 1982, 1991, and then 2009 during the global financial crisis.
Okay, 4, and then 2020.
Then came the Great Lockdown in 2020 caused by the pandemic. That was the 5th, and it was characterized as the worst global downturn since the Great Depression of the 1930s. Just unprecedented depth and speed.
So the big picture here, whether we're talking U.S. or global, is that recession signifies a significant, widespread decline in economic activity. It's not just hitting one number.
Exactly. It's not just about that 2 quarters of negative GDP benchmark. It's a broader deterioration across the economy.
And the official call might come with a delay.
That's the key takeaway.
Right.
Understanding these definitions helps you interpret forecasts and why different institutions might use slightly different language, distinguishing between, say, a severe slowdown and a formal recession, even if the impact feels similar.
Okay, definition set. Now, the crystal ball part. How do the experts look ahead? How do they read the signs to figure out if a downturn might actually be coming? It feels a bit like trying to predict the future, doesn't it?
It certainly feels that way sometimes. But economists use a variety of tools, economic indicators, which tend to move in somewhat predictable ways relative to the overall business cycle.
Leading, coincident, lagging, those categories.
Exactly. We categorize them based on whether they tend to change before, during, or after the broader economy shifts.
And the ones we really want to watch, the ones that give us a potential peek into the future, are the leading indicators.
That's right. Focusing on a collection of these leading indicators gives us a much more robust picture than relying on any single one alone. No silver bullets here.
Okay, so what are the big ones? The yield curve inversion always seems to be in the news.
It's probably the most famous and historically one of the most reliable. Let's break it down simply.
Please do.
Think about the interest rates, or yields, on government bonds, U.S. Treasury bonds. Normally, if you lend the government money for a longer period, say 10 years, you expect a higher interest rate than if you lend it for a shorter period, like 3 months or maybe 1 year.
Right, higher return for locking up your money longer makes intuitive sense.
That's the normal upward sloping yield curve. An inversion happens when that relationship flips. Short-term Treasury yields become higher than long-term Treasury yields.
So lending for 1 year pays more than lending for 10 years. That seems backwards.
It does seem backwards, and that's precisely why it's such a significant signal.
Why is it considered such a powerful predictor of a recession then?
Because it signals that investors in the vast bond market expect interest rates to fall significantly in the future.
Okay.
And the main reason they'd expect future rate cuts is if they anticipate the economy substantially weakening enough that the central bank, the Federal Reserve in the U.S., would need to step in and lower interest rates to stimulate growth.
So the market is essentially pricing in a future economic slowdown and the Fed's reaction to it. Wow.
That's the theory, and the sources really emphasize its historical track record. The New York Fed's research, highlighted in the material, is striking. They found that the spread between the 10-year Treasury yield and the 1-year Treasury yield turning negative, well, it happened before every single U.S. recession since the 1950s.
Every single one. That's remarkable.
They described its rarity outside of a subsequent recession as really quite something. Now, it's not a perfect predictor of timing. The lag can vary, but its track record as a precursor is pretty much unmatched among individual indicators.
That is powerful. Does the inversion itself actually influence the economy or just predict it?
That's a great question. It can create a bit of a self-reinforcing dynamic. When the market signals lower future rates and a weaker economy, it can influence current behavior.
How so?
Businesses might become more cautious, maybe delay big investment plans. Consumers might postpone major purchases, like a car or a house, thinking borrowing costs might be lower later.
Ah, so the expectation itself causes people to pull back.
Exactly. That hesitation, driven partly by the signal from the yield curve, can contribute to the very slowdown it predicts.
What's the typical lead time they mention between the inversion happening and a recession starting?
Historically, a significant and persistent inversion that usually needs to stick around for a bit has often preceded a recession by anywhere from, say, 3 months up to 18 months. Many analyses point to a range of maybe 12 to 18 months as a common historical window.
So not a precise countdown, but a very clear warning signal that gets stronger the longer it persists.
Precisely. A major flag.
Okay, yield curve, check. Definitely one to watch. What are some of the other heavy hitters among these leading indicators?
Consumer confidence and consumer spending are absolutely crucial. You have to remember, consumer spending drives something like 70% of the U.S. economy.
Wow, 70%. So if consumers get nervous?
If consumers become anxious, maybe they're worried about job security, maybe they're feeling squeezed by persistent inflation, or facing high borrowing costs, they tend to pull back on spending.
Especially on the stuff they don't need to buy right away, like discretionary items.
Exactly. Things like new cars, appliances, vacations, maybe eating out less. We watch indicators like the Conference Board and University of Michigan Consumer Sentiment Indexes very closely.
And what signals trouble there?
A sharp, sustained drop in those indexes, particularly if it's followed by actual stagnant or falling retail sales data, especially for those big-ticket items. That's a strong warning sign.
And that can create a downward spiral, right?
It can. It creates a potential negative feedback loop. Fear leads to less spending, which means less demand for businesses. Businesses might then cut production or even lay off workers, which fuels more fear and further cuts in spending. Psychology plays a huge role here in amplifying economic swings.
Yeah, you can see how that builds. What about the stock market? People always watch that.
Yes, though the stock market can sometimes be a bit more volatile or react to things other than just the underlying economy. Still, significant market downturns, what they call bear markets, when major indices like the S&P 500 fall 20% or more from their recent peak, have frequently preceded or coincided with recessions.
Why is that? Investors getting nervous too.
Pretty much. Investors often sell stocks in anticipation of future economic trouble, expecting corporate profits to decline. You also see the VIX index, sometimes called the fear gauge, which measures expected stock market volatility, tend to spike during periods of economic stress.
Is there a typical lead time for the stock market, like with the yield curve?
One analysis mentioned in the sources found that the S&P 500 index tends to peak, on average, about 5 months before a recession officially begins.
5 months before. So investors are often reacting and selling off well ahead of any formal NBER declaration.
That's often the case, yes. They're trying to anticipate the downturn.
Okay. Now, what about the job market? I always thought unemployment usually rises during a recession, not before it. Makes it seem like a lagging indicator.
That's generally true for the overall unemployment rate. It tends to lag. The SAM rule, for instance, is a great tool for confirming a recession is likely underway. It triggers when the 3-month average unemployment rate rises by half a percentage point or more relative to its 12-month low.
Right, confirming, not predicting.
Exactly. But there's a key leading indicator within the labor market data: weekly initial jobless claims.
The number of people filing for unemployment benefits for the very first time each week.
Yes, this is a very timely piece of data released every week. A sustained increase here, for example. The sources mention a rise of maybe 20–25% from its recent low point is an early warning signal,
Why early?
because it indicates that layoffs are starting to pick up across the economy. It suggests businesses are beginning to face weakening demand or increasing cost pressures and are starting to cut staff.
So while the big unemployment rate number is lagging, the weekly claims number gives you a much earlier heads up.
Exactly. It provides a more immediate pulse, a high-frequency read on the labor market's health.
Okay, what else is on the leading indicator list?
You also look at things like new manufacturing orders. These give a forward-looking glimpse into future industrial activity. If orders are falling, production is likely to slow down soon.
Makes sense.
And similarly, building permits signal future construction activity. Declines there suggest slowdowns in the housing and construction sectors are coming.
And I remember seeing things about composite indexes that bundle several indicators together.
Yes, exactly. Like the Conference Board's Leading Economic Index, LEI. This index combines 10 different leading indicators, including jobless claims, manufacturing orders, building permits, the yield spread, consumer expectations, stock prices, and others.
So give us a broader picture.
Right. And a persistent decline in the LEI, especially over several consecutive months, is historically considered a very strong signal that a recession is likely on the horizon. It smooths out some of the noise from any single indicator.
Okay, that sounds important to watch. Credit spreads were also mentioned in the outline as a key indicator. How do those work?
Credit spreads measure the difference in yield or interest rate between riskier corporate bonds and safer government bonds of a similar maturity, like treasuries.
So it's the extra interest companies have to pay because they're riskier than the government.
Exactly. It's the risk premium investors demand to lend to a company versus the super safe government.
And when do these spreads signal trouble?
They signal trouble when they widen significantly. That means investors are becoming more concerned about the possibility of companies defaulting on their debt. It reflects tightening credit conditions in the broader economy.
Tighter credit, meaning it's harder to borrow.
Yes, and more expensive. The source material even quotes a strategist saying credit spreads sometimes rise before the stock market begins to show signs of cracking. When credit gets tighter and more expensive for businesses, it can really choke off investment, expansion plans, and hiring, leading directly towards an economic slowdown.
That makes perfect sense. Harder to get loans, harder to grow or even operate.
Right, and related to that is monitoring business investment trends, often called capital expenditures, or CapEx.
Companies investing in new equipment, factories, technology.
Exactly. When companies start cutting back significantly on that kind of investment, it's a very clear sign they lack confidence in future demand. Or maybe they're facing financial constraints. This directly reduces overall economic activity, hitting GDP, and it's a leading signal of a broader slowdown.
And housing. We touched on permits, but the whole market.
Yes, the housing market is crucial. It's highly sensitive to interest rates, obviously, and it's a major driver of the economy through construction activity, demand for materials, furniture, appliances, and also through household wealth effects.
So what specific housing indicators lead?
Indicators like new building permits, housing starts, actual construction beginning, and existing home sales volume tend to slow down noticeably, often well in advance of a broader economic downturn as rising mortgage rates impact affordability and cool down demand.
Okay. Lastly, how do inventory levels fit into this puzzle?
We watch inventory to sales ratios. This measures the amount of unsold goods businesses are holding relative to how quickly they're actually selling them.
So you don't want inventories piling up too high compared to sales.
Exactly. If this ratio starts to rise sharply and persistently, it means companies have excess inventory building up because demand is weaker than they anticipated.
And what do they do then?
To correct this, they typically cut back on production to work through the excess stock. And cutting production often leads to scaling back hiring, or, unfortunately, even layoffs.
So the real picture emerges when you start seeing a confluence of these signals flashing red, right? Like an inverted yield curve, plus falling consumer confidence, rising jobless claims, widening credit spreads, declines in the LEI, maybe weakness in manufacturing orders and housing. It's the combination.
Absolutely. No single indicator is a perfect crystal ball.
Right.
But when you see consistency and breadth, multiple leading indicators all pointing towards a slowdown, that paints a much clearer and more reliable picture of potential trouble ahead for economists and institutions tracking this.
All right, we've laid the foundation with definitions. We know what warning signs to look for. Now let's get to the main event. What are the actual forecasts saying about the probability and timing of recessions specifically between 2025 and 2030? This is what everyone wants to know.
Okay. Based on this stack of research, the overall consensus from the major global institutions, the World Bank, IMF, OECD, points towards a pretty challenging economic period ahead. The general expectation is for a period characterized by subdued growth globally, rather than necessarily an immediate, guaranteed, deep global recession, particularly looking just at 2025.
Subdued growth. What does that actually mean in terms of global GDP numbers? Sounds kind of weak.
It is relatively weak compared to recent history. The World Bank, for instance, projects average global GDP growth of just 2.5% for the entire 2020s decade. Now, crucially, if you exclude the sharp recession years like 2020, this 2.5% average would represent the slowest pace of growth for any decade since the 1960s.
Wow, slow since the 60s. That puts it in perspective.
It does. And they describe the global economies entering this period as highly vulnerable with, quote, very little buffer against shocks.
So even if it's not technically a formal recession everywhere, the baseline is unusual weakness and fragility compared to what we've been used to. What are the specific forecasts for 2025 looking like?
The forecasts vary slightly, as you'd expect, but the theme is pretty consistent. The World Bank, for example, does not forecast a global recession for 2025 itself, but they do project global growth slowing down to 2.3%.
3.3%.
They describe that as a significant downgrade from previous expectations and anticipate only a tepid recovery expected later in the 2025-2030 period.
Tepid. Another word for not very strong. Lukewarm, maybe.
Exactly. The IMF's global growth forecasts for 2025 were also markedly down revised. They're projecting 2.8% global growth for 2025. And they really emphasize intensifying downside risks.
What kind of risks?
Specifically, they cited uncertainty over global trade policy as being, quote, off the charts. Huge uncertainty there.
Yeah, we'll definitely need to dig into trade policy later. What about the OECD?
The OECD's outlook sees global growth slowing from an estimated 3.3% in 2024 down to 2.9% in both 2025 and 2026. So again, slower growth, but avoiding that global recession label for 2025 itself.
Okay, so the big global bodies generally see slower growth, maybe a fragile situation, but seem to be steering clear of calling a global recession in 2025. What about views focused more specifically on the U.S. or from the private sector?
This is where you start to see perhaps a bit more caution, particularly when looking at signals tied more directly to market expectations or specific regional factors. JP Morgan research, for example, as of late May 2025, had actually reduced their probability estimate for a U.S. and global recession starting in 2025.
Oh, reduced. To what?
Down from 60% earlier to 40%. So while that's lower, a 40% chance is still pretty significant, right? Not negligible at all.
Definitely not. 40% is still a serious risk.
And importantly, they still anticipate subpar growth and material headwinds for the remainder of 2025. Their forecast projected very slow global growth of just 1.3% on an annualized basis in the second half of 2025.
1.3% annualized global growth.
Yeah.
Yeah, that is very slow. That definitely feels the subdued description.
It certainly does. Morgan Stanley forecast global growth at 2.9% in 2025, slowing just slightly further to 2.8% in 2026. They also expect a slowdown, but predict the world will, quote, avoid a recession.
But there are caveats there.
Yes, importantly, their forecast is contingent on certain assumptions playing out, for example, that trade negotiations continue without a full elimination of existing tariffs. It highlights just how sensitive the outlook is to policy decisions and geopolitical events. Things could change.
Okay. And the New York Fed's view for the U.S., that seemed even more cautious based on the yield curve signal.
It did. As of May 2025, based on that yield curve indicator we discussed earlier, The New York Fed's model estimated a 75% probability of a U.S. recession starting within the next year.
75%? Wow, that's high.
It is high. Now, context is important.
Yeah.
This was actually down from an even higher probability, around 83%, that their model had estimated about 18 months prior. But still, a 75% probability is described in the analysis as being high by historical standards.
So that suggests a much more elevated risk profile specifically for the U.S. economy compared to some of the broader global projections, or even J.P. Morgan's 40%.
It certainly points that way. It underscores that even within the general consensus of slower growth, there are definitely differing views on the probability and timing of an actual downturn, especially for the U.S., based on specific indicators like the yield curve.
And like you mentioned earlier, that distinction between a severe slowdown, weakest growth in decades, subpar growth, and a formal technical recession might feel pretty academic to businesses and individuals actually experiencing reduced demand and job insecurity.
Exactly. The impact on the ground might feel very similar, even if it doesn't tick every single box for an official NBER or IMF definition. And many of these no-recession forecasts carry significant contingencies, making the whole outlook quite fragile and very susceptible to negative surprises.
Okay, so while 2025 might see slower growth globally, maybe dodging a formal global recession declaration, the risk is clearly elevated, and maybe particularly so for the U.S., according to some key metrics. What about the outlook beyond 2025, looking further out into 2026, 2027, towards 2030?
Most forecasts extending into 2026 and 2027 show either a continuation of that tepid recovery or just more of that subdued growth environment we mentioned. Remember that World Bank projection of only 2.5% average growth for the entire 2020s decade.
Right, the slow decade.
However, one of the source analyses we looked at specifically tried to break down the potential recession timing into distinct probability windows looking out towards 2030.
Probability windows.
Okay.
Okay, that sounds interesting. Less about pinpointing a date, more about periods of higher risk.
Exactly. The first and arguably highest probability window identified in that analysis was late 2025 extending through mid-2027. This time frame was assigned a moderate to high probability for a recession to occur.
Late 2025 to mid-2027. Why is that specific period highlighted as having particularly high risk? What's the reasoning?
The primary reason cited is the anticipated lagged impact of all that aggressive monetary policy, tightening the sharp interest rate hikes undertaken by central banks globally between roughly 2022 and 2024 to combat inflation.
Right, the hikes we all felt.
Historically, these rate hikes don't hit the real economy immediately. Their full effects tend to work through the system with a significant lag, often taking 12 to 24 months to be fully felt across borrowing, investment, and spending.
So the timing fits.
Exactly. Given the peak of the rate hike cycle in many major economies was around mid to late 2024, this late 2025 to mid-2027 period falls squarely within that historical impact window, where the negative effects are most likely to materialize and potentially tip the economy over.
So the medicine used to fight inflation could end up causing a significant slowdown or even recession a bit later.
That's the core concern driving this particular risk window. And the analysis listed several specific potential triggers that could push the economy into recession during this period.
Okay, like what?
A major one is a potential debt servicing shock. Think about all the corporate and government debt that was piled up during the era of ultra-low interest rates.
A lot of cheap borrowing happened then.
A huge amount. As that debt matures over the next few years and needs to be refinanced at the much higher current interest rates, the cost of just servicing that debt making the interest payments could skyrocket. This could lead to widespread financial stress, business failures, defaults, and a sharp pullback in business investment. It's sometimes called the debt wall.
Okay, the debt wall. What else?
There's also the risk of consumer exhaustion. Those excess savings many households built up during the pandemic, they've largely been spent down now. Meanwhile, years of inflation have eroded real purchasing power, and high interest rates make borrowing for everything, credit cards, car loans, mortgages, much more expensive.
So consumers are getting squeezed from multiple directions.
Exactly. This hits consumers' ability and their willingness to spend, potentially leading to a significant retrenchment in demand, which, remember, is 70% of the U.S. economy.
And we can't forget the risk of policymakers messing up, right? Policy error risk.
Absolutely not. A significant policy error risk looms very large in this period. Central banks face that incredibly difficult tightrope walk we mentioned.
How so?
Holding interest rates higher for longer, for too long, could unnecessarily push the economy into recession by overshooting and crushing demand more than needed. But conversely, cutting rates too early before inflation is truly vanquished could allow inflation to flare up again, forcing them to hike rates even more later, potentially causing an even worse outcome.
Damned if you do, damned if you don't, almost.
It's an incredibly challenging judgment call, made even harder by the lags in how policy affects the economy and how data comes in. There's also the persistent risk of geopolitical spillover.
Meaning conflicts flaring up.
Yes, existing conflicts worsening or new tensions erupting could disrupt global supply chains, again, maybe for energy, food, or critical components like semiconductors. This could trigger new supply shocks, adding to inflation and uncertainty, further complicating the picture.
And one more trigger mentioned was commercial real estate.
Yes, a potential commercial real estate CRE crisis is a major concern highlighted in the sources for this 2025-2027 window. You've got several factors converging: high vacancy rates in office buildings due to remote work trends, the massive amount of CRE debt coming due for refinancing in the next few years.
At much higher interest rates now.
Exactly. Combined with falling property valuations in some segments. This creates a recipe for potential widespread defaults among property owners.
And that hits the banks.
It could significantly impact banks, especially regional banks that often have heavy exposure to CRE loans. This could lead to tighter credit conditions across the board, affecting lending to all sorts of businesses, not just real estate.
Okay, those are some really potent potential triggers, all converging in that late 2025 to mid-2027 window. Is there another probability window identified later in the decade?
Yes, the analysis also identified a second window, assigned a moderate probability. This one falls in late 2028 through 2030.
Late 2028 to 2030. What's the thinking there? This scenario seems to assume we get through the next couple of years without a total meltdown.
That's right. This scenario implicitly assumes the global economy navigates those mid-decade risks we just discussed: the lagged rate hike impact, the debt wall, the CRE stress, without collapsing into a really deep, prolonged recession. It assumes maybe a slowdown or a mild recession, followed by a period of fragile, somewhat subdued expansion in between, leading into the later part of the decade.
So if we manage to avoid a major downturn in the next couple of years, why would the risk potentially increase again towards the end of the decade, 2028, 2030? What are the triggers then?
The potential triggers identified for this later window are often tied more directly to some of the deeper, longer-term structural forces that are reshaping the economy, forces we'll need to discuss in more detail.
Okay, like what structural forces?
One potential risk mentioned is asset bubble deflation. If central banks do end up cutting interest rates significantly after navigating the mid-decade risks, perhaps to stimulate growth.
The cheap money could flow somewhere.
Exactly. The resulting flood of liquidity could potentially fuel new asset bubbles, maybe in areas related to AI hype, or perhaps a resurgence in certain real estate markets or specific stock sectors. And eventually those bubbles could burst, triggering another downturn. Think dot-com bubble bursting in 2000 or the housing crash before 2008.
Right, the classic boom-bust cycle fueled by policy responses.
It's a potential dynamic.
Right.
Another major trigger discussed for this later period is fiscal unsustainability. Government debt levels have surged globally, as we know, pandemic responses, stimulus measures, plus growing structural spending needs for things like the energy transition, defense, or aging populations.
So governments owing too much money becomes a problem.
It could, if investor confidence in government's ability to manage this debt starts to wane. That could push government borrowing costs prohibitively high, potentially forcing governments into painful austerity measures, slashing spending or raising taxes sharply, which would severely dampen economic growth. The source material specifically mentioned the rising interest costs on the U.S. national debt as a significant structural fiscal challenge to watch.
Okay. And those big structural shifts we keep hearing about: AI, climate change, demographics, are they more likely to be triggers later in the decade?
Yes, the report suggests that if the global economy manages to survive the more immediate cyclical risks of the mid-decade, the accelerating impacts of these major structural shifts could become more significant recessionary triggers later on in that 2028-2030 window.
How so?
This includes the growing frequency and severity of climate-related physical risks, disrupting economies. Think more intense storms, droughts, floods impacting agriculture, infrastructure, insurance costs. It includes the compounding effects of demographic decline, leading to persistent labor shortages and fiscal strain in many advanced economies. And it includes the potential for AI-driven labor market disruption to cause widespread uncertainty and reduce aggregate demand if the transition isn't managed smoothly and workers are displaced faster than they can adapt.
So the underlying tectonic plates start to cause bigger quakes later on.
That's one way to think about it. Add to that the potential for deepening geopolitical fracturing, further decoupling between major economic blocs imposing ongoing costs, and persistent greenflation, where the costs and supply bottlenecks associated with the transition to green energy act as a persistent drag on growth and a source of inflation. All these could converge to create recessionary pressure later in the decade.
So the nature of the trigger seems to shift from being largely cyclical, like the lagged effects of rate hikes and debt cycles in the mid-decade window, to becoming more structural and potentially more disruptive forces later in the decade. Is there any scenario discussed where things actually look brighter in the middle, say around 2027?
The analysis did briefly mention a scenario where mid to late 2027 could potentially be a trough, meaning the low point before a recovery. But importantly, this was assigned a lower probability.
What would need to happen for that brighter scenario?
It would really only happen if a relatively mild recession were to occur earlier, say in late 2025 or 2026. In that case, central banks would likely respond quite aggressively, cutting interest rates significantly, and governments might implement some fiscal stimulus by 2026.
The classic policy response.
Right, and that combined policy boost could potentially reignite growth by 2027, leading to a recovery, maybe even a V-shaped one.
But it's less likely.
Yes. The report really cautioned that this scenario is highly dependent on any preceding downturn being relatively mild, and crucially, on the absence of significant new negative shocks emerging during that time. It was definitely presented as a less likely outcome compared to the risks highlighted in those other two main probability windows.
Okay, so let's try to rack up the forecasts then. While a deep, immediate global recession isn't the consensus baseline for 2025, the overall outlook is for significantly slower, more vulnerable global growth than we've been used to.
That's the big picture, yes. Fragility and slower growth.
And within that, the analysis points to late 2025 through mid-2027 as the period with the highest probability for recession to actually hit, driven largely by the lagged effects of past monetary tightening hitting things like debt servicing, consumer spending, and maybe triggering issues in commercial real estate or from geopolitics.
Correct. That's the primary risk window identified.
And then there's a secondary risk window later in the decade, say late 2028 to 2030, where the triggers might be more related to deeper structural issues like fiscal unsustainability, potential asset bubbles bursting, or the disruptive impacts of AI, climate change, and demographics really starting to bite harder.
That accurately captures the landscape presented in the sources. The key takeaway isn't just if a recession happens on a specific date, but recognizing that the entire 2025-2030 period seems characterized by these underlying fragilities and structural headwinds. These make the global economy inherently more susceptible to downturns than perhaps it was in recent history, regardless of the exact timing or trigger.
This brings us perfectly to the driving forces behind all this and the major risks and structural changes that are combining to create this complex and frankly volatile environment for the next few years. It's clearly not just one single factor causing this, is it? It's the mix.
Absolutely not. Recessions are almost always the result of multiple factors converging, multiple pressures building up. And the sources consistently describe this 2025-2030 period as being particularly marked by a confluence of several significant interconnected risks, all hitting at roughly the same time, creating what one report termed a highly complex and volatile risk landscape.
Like several major tectonic plates are shifting at once, maybe?
That's a good analogy. And one of the biggest plates shifting right now seems to be geopolitical tension and trade fragmentation. This came up again and again as a massive factor.
How is that playing out?
It's a major driver of disruption and presents significant downside risks to global growth. The sources highlight a really worrying trend towards rising protectionism and the proliferation of tariffs and other trade barriers globally. The data cited from the 2024 G20 trade monitoring was quite stark.
What did it show?
Over 2,400 new trade-restricting measures were introduced by G20 economies in the period they looked at, vastly outnumbering the just over 600 measures aimed at liberalizing trade.
Wow, that imbalance is huge. 4 times as many restrictions as liberalizations.
It's a very clear signal of a global shift away from integration and towards fragmentation, driven by escalating geopolitical rivalries and more domestic-focused industrial policies. The IMF was quite blunt about it.
What did they say?
They stated that uncertainty over global trade policies is, quote, off the charts, and that this uncertainty is actively working to undercut global growth, push up prices for consumers and businesses, and disrupt financial markets.
How how does this fragmentation hurt the economy beyond just making imported goods maybe a bit more expensive? What are the wider
It
impacts?
has really wide-ranging negative impacts across the board. It stifles competition, which over time reduces innovation and productivity growth, key drivers of rising living standards. It disrupts established global supply chains, making them less efficient, more costly, and more vulnerable to future shocks.
Yeah, we saw that with the pandemic.
Exactly. It also reduces cross-border investment because businesses become hesitant about accessing foreign markets or setting up operations abroad if they fear sudden policy changes or tariffs. Ultimately, the sources conclude it means higher costs for consumers and businesses, lower overall global growth potential, and a greater risk of inflation resurging due to less efficient production and persistent supply bottlenecks.
The new U.S. trade policy, particularly the prospect of higher tariffs, was even called a structural shock in one analysis.
Yes, the analysis pointed to the uncertainty and the direct costs generated by both the prospect and potential implementation of significantly higher tariffs in the U.S. JP Morgan's estimate was highlighted. They calculated that the anticipated effective ex-ante U.S. tariff rate of around 13.4% would be equivalent to roughly a $430 billion tax hike on U.S. households and businesses.
$430 billion, that's about 1.4% of U.S. GDP. That's huge.
It's a very significant potential drag. And this doesn't just impact the U.S., it dampens global demand and really scrambles established international trading patterns. Reflecting this concern, the World Trade Organization, WTO, significantly downgraded its forecast for global goods trade volume for 2025. They now expect it to actually fall slightly by 0.2% instead of the 2.7% expansion they had previously anticipated.
A complete reversal from expansion to contraction in the forecast. And the World Economic Forum survey suggested more of this fragmentation is expected.
Unfortunately, yes. A forecast from the WEF cited in the material found that a huge majority, 94% of chief economists they surveyed, expect further geopolitical fracturing and trade fragmentation over the next 3 years.
Why?
Driven mainly by escalating rivalries between major powers and domestic policy priorities, increasingly taking precedence over global economic integration. They also anticipate increased barriers to the international mobility of labor and technology, adding yet more layers of inefficiency and complexity to the global economy.
Okay, so rising geopolitical tensions translating directly into trade walls and uncertainty is a major piece of this volatile landscape. What about the second big driver? Monetary and fiscal policy trajectories, the actions of central banks and governments.
Central banks, as we touched upon, are in an incredibly difficult position right now. They've raised interest rates aggressively over the past couple of years to fight inflation, but now they're balancing the need to ensure inflation is truly and durably contained against the very real risk of over-tightening policy and triggering a severe economic downturn.
The policy error risk again.
Exactly. As the sources repeatedly noted, mistimed or outsized policy decisions tightening too much or perhaps easing too soon carry a high risk of triggering or significantly exacerbating a recession.
What's the specific expectation mentioned for the U.S. Federal Reserve during this 2025-2030 period? What are they likely to do?
The dominant view coming through the sources, particularly from analysts at JP Morgan and Morgan Stanley, is that the Fed will likely keep its key interest rate relatively high, holding steady until relatively late in the game, perhaps not starting to cut rates until late 2025 or even early 2026.
Why wait so long if growth is slowing?
Their primary mandate, or at least their current focus, remains getting inflation definitively back down to their 2% target. They may feel compelled to keep rates restrictive, even if growth visibly slows, partly because some of the other factors we're discussing, like potential new tariffs, could actually boost inflation before they cause a significant growth slowdown. So they might prioritize fighting inflation first.
So JP Morgan predicted the first Fed cut when?
JP Morgan predicted the first Fed rate cut wouldn't happen before December 2025, followed by perhaps 3 more cuts by the second quarter of 2026. Morgan Stanley was slightly more delayed, anticipating the Fed would wait until March 2026 before beginning a series of cuts, maybe totaling around 175 basis points, 1.75% by the end of 2026.
So the overall message is, the Fed is likely to err on the side of keeping its foot on the brake longer, to be absolutely sure inflation is beaten, even if the economy starts to sputter significantly in the meantime.
That seems to be the general read on the Fed's likely priorities based on these analyses. Now, in contrast, the European Central Bank, ECB, facing somewhat different economic conditions and maybe lower underlying inflation pressure in the euro area.
They already started cutting?
Yes, the ECB already started easing rates with a cut in April 2025, and Morgan Stanley forecasts them continuing to cut rates fairly significantly over the next year, perhaps down to 1.5% by December 2025. This leads to another risk factor: divergent monetary policies.
How do different central banks doing different things create risk for the global economy?
When major central banks are moving in opposite directions, like the Fed potentially holding firm while the ECB cuts aggressively, it can cause significant and volatile capital flows between currency blocks. It can also lead to large swings in exchange rates.
Making trade and investment more unpredictable.
Exactly. It can exacerbate existing economic imbalances between countries and make it easier for financial shocks to transmit across borders. This adds yet another layer of uncertainty and potential instability to the global system.
This really feels like that classic stagflationary challenge from the 70s, maybe trying to manage slowing growth alongside persistent, tricky inflation. It puts policymakers in a very tough spot.
It really does. The risk of policy error is inherently high in such an environment, partly because economic data isn't perfect, it often comes with lags, and the effects of monetary policy also work with long and variable lags. So, policymakers are always navigating by looking in the rearview mirror to some extent. This overall policy uncertainty, not just about trade, but also about how central banks and governments will react to a rapidly changing landscape, adds significantly to the overall economic volatility expected in this period.
Okay, what about the fiscal side, government spending and debt? That also plays a role, right?
Absolutely. Globally, government debt levels have increased significantly due to the pandemic responses, subsequent stimulus efforts, and now growing structural spending needs.
What kind of needs?
Things like increased defense spending in some regions, investments needed for the green energy transition, and the rising costs associated with aging populations, pensions, healthcare. The sources suggest that major economies like the US, the Euro area, and China are all facing pressures or, in some cases, intentions to increase government spending, which likely means larger public deficits in the coming years.
Is that sustainable?
That's the question. For the U.S. specifically, the rapidly rising cost of just paying the interest on the enormous national debt, especially at these higher interest rate levels, is highlighted as a significant structural fiscal challenge going forward.
And what about developing economies?
For emerging market and developing economies, EMDEs, and particularly for low-income countries, LACs, the fiscal constraints are even tighter. They have very limited resources and often limited borrowing capacity. The advice from institutions like the World Bank is that they urgently need to find ways to mobilize more domestic revenue, improve tax collection, for example, prioritize spending very carefully on the most vulnerable populations and growth-enhancing investments, and strengthen their overall fiscal frameworks to build resilience. They simply don't have the fiscal space that richer countries might have to cushion against shocks or stimulate growth.
Okay, fiscal pressures adding to the mix. Let's move to the next big driving force. Technological transformation, specifically the impact of artificial intelligence, AI. This is huge right now.
AI is undeniably a potential engine for massive long-term productivity gains. The upside potential is staggering. The sources cite some really impressive estimates.
Like what?
Generative AI alone potentially adding $2.6 to $4.4 trillion annually to the global economy by 2040. PwC estimating AI contributing a total of $15.7 trillion to global GDP by 2030. IDC projecting that every dollar spent on AI development could add nearly $5 in value by 2030. The long-term potential is huge. Okay, that's the long-term upside. But what are the risks, specifically for this 2025 to 2030 period we're focusing on? Where's the friction? The critical risks identified in the sources for the short to medium term, meaning right now through 2030, are primarily related to labor market disruption. The scale is potentially massive. How massive? The IMS estimates that AI could affect, in some way, a staggering 40% of jobs globally. And that number jumps to up to 60% in advanced economies like the US and Europe. Affect how? Replacing jobs. It's a mix. Either by automating tasks currently done by humans, or by significantly changing the nature of jobs, complementing workers, but requiring new skills. While some projections suggest that, overall, more jobs might eventually be created by AI, one source cited 170 million created by 2030, then are explicitly displaced. Maybe 92 million disappear by 2030. The transition is the absolutely crucial part.
Right. It's not just the net number. It's about the speed and the match, isn't it? Are the new jobs created quickly enough? Are they in the right places? And critically, are they for the people whose old jobs are disappearing? Can those people get the skills for the new roles?
Exactly. That's the core challenge for this decade. If the pace of job displacement caused by AI adoption significantly outstrips the pace of new job creation, or if there are major skill mismatches where displaced workers in, say, administrative roles lack the skills needed for new roles in AI development or data science, you could see temporary but potentially significant spikes in unemployment.
Especially in specific sectors or for certain demographic groups.
Precisely. And if you have rising unemployment, even temporary, what happens? It directly reduces consumer confidence and overall consumer spending, those known recessionary pressures we discussed earlier with the leading indicators.
So the actual transition to an AI-integrated workforce happening right now through 2030 could be quite volatile and potentially act as a drag on the economy.
It could be highly volatile, yes, if it's not managed proactively and effectively by governments and businesses. This transition isn't automatic or painless. It requires massive, coordinated investment in education systems, in large-scale reskilling and upskilling programs, and potentially in strengthening social safety nets to support displaced workers and help people acquire the skills needed for the new economy.
And if that doesn't happen?
Failure to make these investments or making them too slowly could turn what should be a hugely beneficial technological shift into a major source of economic instability. It could lead to social unrest, and it would almost certainly exacerbate existing inequalities between high-skilled and lower-skilled workers.
And the sources mentioned other AI risks beyond just the job displacement aspect.
Yes, several others. There are significant concerns about the potential concentration of economic power in the hands of just a few large corporations that develop and control the most advanced AI models. This could stifle competition and innovation down the line.
And global inequality.
AI could definitely exacerbate global inequality if developing countries lack the necessary infrastructure, the skilled talent, or access to the vast data sets needed to participate meaningfully in the AI revolution. The gap could widen significantly. There are also well-documented risks related to bias embedded in AI models, often trained on historical data that reflects past societal biases. This could lead to discriminatory or unfair outcomes in critical areas like hiring, loan applications, or even criminal justice.
Okay, so AI is clearly a double-edged sword. Huge long-term potential, but its integration during this 2025-2030 period carries significant risks related to labor disruption, inequality, and concentration of power that could act as economic headwinds or sources of instability if not carefully managed. What about the next structural force, demographic shifts?
Demographics represent a slower-moving but incredibly persistent structural headwind, particularly for many advanced economies and also increasingly for countries like China.
What are the key trends?
Two main things globally: slowing overall population growth and rapidly aging populations within many countries. The average age of the population is increasing, and the proportion of people aged 65 and over is rising significantly worldwide. This isn't a short-term blip, it's a long-term structural shift.
And how does that structurally slow down an economy over a period like 2025, 2030?
It impacts the economy in several ways. Directly, it affects the labor supply. A shrinking or more slowly growing working age population, combined with an aging workforce, limits the number of available workers. This puts a cap on the economy's potential to produce goods and services, thus limiting potential GDP growth.
Businesses are feeling this already.
Absolutely. Businesses are already reporting labor shortages as a significant challenge. One source noted that 63% of businesses surveyed cited the inability to attract the right talent as a barrier to their growth, and these underlying demographic shifts are a major factor contributing to that difficulty.
Okay, so direct impact on labor supply, limiting growth potential. What about indirect impacts?
Indirectly, aging populations put increasing fiscal pressure on governments. As the share of retirees grows relative to the working population, demand surges for public services like pensions and healthcare, while the tax base contributing to fund these services may grow more slowly or even shrink.
And that fiscal pressure makes it harder for governments to respond effectively if a recession hits.
Precisely. Increased mandatory spending on things like pensions and healthcare reduces the government's fiscal flexibility. They have less discretionary money available to use for countercyclical policies like tax cuts or spending programs to stimulate the economy during a downturn. This makes economies potentially less resilient to shocks.
So demographics aren't necessarily a sudden trigger for a recession on their own, like a financial crisis might be, but they act more like a steady headwind, making the economy weaker overall and potentially making any recession that does occur more severe or prolonged.
That's exactly the right way to think about it based on the sources. Demographic headwinds should be seen as factors that amplify the impacts of other, more immediate risks, like trade fragmentation, policy errors, or AI disruption. They contribute to the overall vulnerability and make the economy less resilient than it might otherwise be.
Are there ways to mitigate these demographic pressures?
Yes, the sources mentioned some potential mitigating factors. Trends towards healthier aging could allow people to work longer, boosting labor force participation among older cohorts, the silver lining, as one report put it. Policies that actively support healthy aging encourage higher workforce participation rates, especially among older workers and women, and facilitate the effective integration of migrants and refugees can certainly help offset some of these headwinds. But the underlying structural pressure from aging populations remains a significant factor shaping the economic landscape through 2030 and beyond.
Okay. Beyond these major structural drivers, trade, policy, AI, demographics, the sources also briefly mentioned other potential shocks that could suddenly trigger a downturn, even if the underlying conditions are just slow growth.
Yes, even in a fragile, slow-growth environment, sometimes you still need a specific spark to actually ignite a recession. These could include classic triggers like sudden financial crises, perhaps caused by unexpected tightening in credit conditions or asset bubbles boosting in some sector, or housing market crashes, which hit household wealth hard, dent consumer confidence, and paralyze construction activity, or sharp commodity supply shocks.
Like oil prices suddenly spiking.
Exactly. A sudden geopolitical event, for instance, that sends energy or food prices skyrocketing could severely disrupt both demand by hitting purchasing power and production by raising costs. Any of these, if severe enough, could act as the immediate trigger that pushes a vulnerable economy over the edge into a formal recession.
Finally, let's talk about climate change. We increasingly hear this framed not just as an environmental issue, but as a fundamental economic and financial risk. How does it factor into the specific 2025-2030 outlook?
Climate change is rapidly emerging in these analyses, not just as a long-term threat, but as a fundamental systemic risk to the financial sector itself, and therefore to the stability of the global economy, even in the medium term.
Systemic risk, meaning it could bring down the whole system.
Potentially, yes, in the longer term. The severe long-term projections are truly alarming scenarios like 3 degrees Celsius of warming, potentially reducing global GDP by a staggering 50% by 2070 or 2090 due to widespread ecosystem breakdown, mass migration, and even state failure. Some reports frame it as an existential threat to the current financial model, questioning if insurers will even be able to cover climate-related risks in the future, which could have cascading impacts on mortgages, real estate values, and overall financial stability.
Okay, those are the dire long-term warnings, but what about the concern specifically for the 2025-2030 timeframe we're focused on? How is it acute now?
The crucial point coming through the sources for this period is that the physical risks of climate change are accelerating rapidly,
Physical risks meaning?
meaning the direct impacts from the changing climate itself. The increasing frequency and severity of extreme weather events, hurricanes, floods, wildfires, heat waves, rising sea levels affecting coastal areas, water scarcity impacting agriculture and industry, things like that. The analysis suggests these physical risks are projected to grow so rapidly that their economic and financial impacts are starting to outweigh the economic impacts of the transition to a green economy, at least in the near to medium term.
So the damage from climate change itself is ramping up faster than the costs or benefits of trying to fix it right now.
That seems to be the assessment. One report cited projected the economic impact of climate-related physical risk quadrupling by 2050 in some scenarios, compared to today. This translates directly into climate-related shocks becoming potentially more frequent, more severe, and more economically disruptive within our 2025-2030 timeframe.
So we need to think of climate change not just as a slow environmental burn, but increasingly as a source of sudden, unpredictable economic disruptions right now.
Exactly. These aren't just environmental events anymore. They are becoming acute economic shocks. Major floods, widespread droughts, devastating wildfires, Category 5 hurricanes. These can instantly disrupt critical supply chains, destroy billions in infrastructure, decimate agricultural yields, trigger costly internal displacement or cross-border migration, and cause massive insured and, importantly, uninsured losses that ripple through the financial system.
And these climate shocks interact with all the other vulnerabilities we've discussed.
Precisely. Climate risk needs to be integrated into economic forecasting and risk management, not just as some abstract long-term trend, but as a significant source of immediate disruptive shocks that interact with and amplify all the other vulnerabilities: trade fragility, policy constraints, AI disruption impacts, demographic pressures. It demands proactive risk management from governments, businesses, and the financial sector starting now, not waiting for some future date.
Wow. Okay. So putting it all together, the 2025-2030 period is being shaped by this incredibly complex interplay of major forces all hitting at once. You've got trade fragmentation driven by geopolitics, central banks walking a very difficult policy tightrope with a high risk of error, the disruptive, uncertain transition phase of AI adoption, persistent structural headwinds from demographic shifts slowing growth potential, and now rapidly escalating physical risks from climate change acting as unpredictable, amplifying shocks. It really does sound like a genuinely volatile and uncertain environment ahead.
That confluence of factors, the sheer number of significant interconnected challenges all active simultaneously, is precisely what defines the unique risk landscape for this period, making it essentially quite distinct from previous economic cycles we've experienced.
Okay, let's shift gears slightly. Given all these global forces and risks, how are things expected to play out differently in different parts of the world? And what about specific sectors? Is everyone affected equally? Let's look at regional variations and sector spotlights.
Right, because the global picture is an average, but the experience on the ground can vary quite a bit. The sources provide some regional snapshots.
What about the United States? We heard the NY Fed saw high recession probability. What else?
Yeah, the U.S. is generally expected to see a significant slowdown. Morgan Stanley projected U.S. growth at just 1.5% in 2025, slowing further to 1% in 2026. The OECD was similar at 1.6% for 2025. JP Morgan was even more subdued, forecasting growth of only 0.25% annualized in the second half of 2025.
Basically grinding to a halt in late 2025, according to JPM. What about inflation in the U.S.?
Interestingly, some forecasts anticipated U.S. inflation might actually accelerate again temporarily, perhaps peaking around 3.5% in the third quarter of 2025.
Why would it reaccelerate?
Partly due to the potential impact of new tariffs pushing up import prices, and also ongoing labor market tightness in certain sectors contributing to wage pressures. We also saw consumer confidence in the U.S. reportedly tumbled in March and April 2025, hit by market volatility and those sticky inflation concerns. And as we discussed, the Fed is expected to keep holding rates high through much of this.
Okay, so U.S. slow growth, maybe sticky inflation, high recession risk flagged by the Fed. What about the euro area?
The euro area is expected to see modest growth, but generally slower than the U.S. initially. Morgan Stanley forecast 1% growth in 2025. The OECD also saw 1.0% for 2025. The World Bank was a bit more optimistic at 2.4% for 2025, but still relatively subdued. And remember, the ECB already started cutting rates in April 2025, reflecting perhaps weaker growth dynamics there compared to the U.S.
And China, always a key engine of global growth.
China's growth is expected to continue moderating from its very high rates of the past. The OECD projected 4.7% growth in 2025. The World Bank saw 4.5% for 2025. While they apparently had a strong first quarter in 2025, 5.4% reported, the trend is generally expected to be slower growth compared to pre-pandemic levels, facing challenges in the property sector and shifting towards domestic consumption.
What about emerging market and developing economies, EMDEs as a whole?
Overall, EMDEs are projected to slow down, growing around 3.8% in 2025, according to the World Bank. That's significantly below their average growth rate in the 2010s. Within that group, there's variation.
How so?
Growth in the poorest countries, the low-income countries, LICs, is seen as highly contingent on conflict de-escalation and inflation moderation. Regionally, areas like the Middle East and North Africa, MENA, and Sub-Saharan Africa might see some strengthening, while regions more reliant on global trade like East Asia and Pacific, Europe and Central Asia and South Asia are expected to slow down due to the weaker global trade outlook we discussed.
It might be useful to make this more concrete. The sources included a comparison between the U.S. and Bangladesh. How does that illustrate the different experiences right now?
Yeah, that comparison really highlights the divergence. While the U.S. was seeing inflation moderate down towards maybe 3–4% by 2025, Bangladesh was grappling with much higher inflation, reportedly running between 9–11% for much of late 2024, even spiking over 11% due to currency depreciation, the taka losing value. So very different inflation pressures.
What about their stock markets?
Again, huge divergence. The U.S. stock market, the S&P 500 and NASDAQ, were reported near record highs in the analysis period. In contrast, the main index in Bangladesh, the DSX, had slumped significantly, down around 16% in 2024, hitting near five-year lows.
Why the slump in Bangladesh?
Attributed to weak corporate profits, high domestic interest rates, general economic anxiety, political unrest, and a notable absence of foreign investors. Very different market sentiment.
And the broader macro fundamentals.
The U.S. was described as being near full employment, around 3.6% unemployment, with GDP growth still positive, maybe 2–3% annualized. Bangladesh, however, saw its growth slow, sharply projected around 3.9% for fiscal year 2025, way down from its previous 7–8% growth rates. High inflation and political unrest were cited as denting investment and exports.
Any other major difference?
Yes, a crucial one. Foreign exchange reserves. Bangladesh had seen its reserves drawn down significantly, reportedly to around $24 billion in late 2024, limiting its buffer to manage external shocks or pay for imports. The U.S. obviously doesn't face that kind of external constraint due to the dollar's global role.
So summarizing that comparison, Bangladesh was facing more acute current strains, very high inflation, currency pressure, dwindling reserves, slow growth. The U.S., while facing a slowdown, still had strong employment and markets, but was showing more of those classic late-cycle warning signals we discussed earlier, like the inverted yield curve and softening leading indicators. Both face shared global risks, but their immediate situations and vulnerabilities look quite different.
Exactly. It's a good illustration of why a single global forecast doesn't tell the whole story.
Now let's zoom in on sector-specific risks. The tech sector often gets a lot of attention. Is it seen as particularly vulnerable in this environment?
Yes, the tech sector was highlighted as potentially especially vulnerable. It benefited hugely from the era of ultra-low interest rates and massive venture capital investment. Now, facing higher rates and slowing growth, many tech companies were already seeing trimming costs significantly.
We certainly heard about a lot of tech layoffs.
The numbers were stark. The sources mentioned massive cuts continuing from 2024 into 2025, something like 150,000 tech jobs cut globally in 2024, with tens of thousands more announced by major players like Amazon, 27,000 since 2022 mentioned, and Microsoft, 6,500 early 2025 mentioned, continuing the trend.
What's driving those cuts?
Reflects decelerating demand in key areas like cloud computing growth, online advertising spending, and consumer electronic sales compared to the boom during the pandemic.
So how would a broader recession impact the tech sector?
If a recession hits, businesses typically slash capital budgets, and spending on IT systems and telecommunications often gets cut back. This would hit demand across the board: software, hardware, semiconductors. Plus, many tech stocks still carried high valuations, high price-to-earnings ratios, and some companies took on significant corporate debt during the boom years. This combination means a potentially steep correction in the sector is possible during a downturn.
Are there any sectors considered more defensive that might hold up better?
Traditionally, sectors like healthcare, consumer staples, companies selling everyday necessities like food and household products, and utilities tend to be more defensive during recessions, as demand for their products and services is less cyclical. Some analysts also suggested that even certain traditional industries like energy and mining might hold up better in the current environment due to supply constraints or geopolitical factors.
But is the risk just concentrated in tech? What about the broader economy?
While tech is sensitive and often moves early, the risk isn't confined there, especially in a potentially deeper downturn. The analysis mentioned that even sectors like manufacturing and finance are considered at risk. One source referenced Federal Reserve stress test scenarios, which projected potentially widespread layoffs extending well beyond tech-hitting sectors like auto manufacturing, construction, and even government services, potentially pushing the unemployment rate from around 4% up towards 10% in a hypothetical severe downturn scenario.
10% unemployment. That would be severe.
Very severe. So the conclusion really is, while tech might be particularly sensitive and a leading indicator of trouble due to its growth orientation and valuation sensitivity, a deep or prolonged recession would inevitably impact most sectors of the economy significantly. Tech wouldn't be alone.
This is a lot to digest, but it paints a much clearer, albeit complex, picture of what the experts are looking at. Given this new normal, this projected period of structurally slower growth, increased vulnerability to shocks, and persistent volatility, what does this actually mean for us, for you listening? And how can individuals and businesses navigate this future?
Yeah, that's the crucial question. The sources consistently describe the 2025-2030 period not just as potentially including a recession, but as representing a fundamentally different kind of economic environment compared to maybe the decade before the pandemic. A new normal, as you said.
Characterized by
structurally slower global growth as a baseline, heightened vulnerability to a wider range of shocks, geopolitical, climate, technological, and potentially slower, more protracted recoveries when downturns do occur. It's described as uncharted territory in some ways, with heightened policy uncertainty contributing to a persistent state of elevated volatility.
So volatility isn't just something that happens occasionally during a crisis. It might be a more constant feature of the economic landscape now. Is that the implication?
That seems to be the underlying message, yes. The interconnected nature and the sheer scale and speed of these major structural forces we've discussed, the trade fragmentation, the policy challenges, the AI transition, the demographic pressures, the accelerating climate risks, they mean that the underlying stability of the global economy might be inherently more fragile than it was. Shocks are potentially more likely to occur, and their effects could ripple through the system more severely and last longer.
Okay. With that rather sobering outlook in mind, what are the most essential things we should all be monitoring based on these expert analyses? If you're listening, what key indicators should you really keep your eyes on to navigate this?
Based on the analysis, several key areas demand continuous attention. First, you absolutely have to keep monitoring trade policy and geopolitics. Watch for any significant escalations or de-escalations in trade disputes, especially between major blocs. Keep track of the implementation of new tariffs or trade barriers. And watch shifts in global alliances, as these have direct implications for supply chains, business costs, and overall growth prospects.
And the central banks are obviously critical.
Absolutely critical. Monitor central bank actions in the inflation trajectory. Pay very close attention to the interest rate decisions, the meeting minutes, and the forward guidance coming from major central banks, particularly the U.S. Fed and the ECB. Track inflation data closely, both headline and core inflation, especially in the U.S., given the potential impact of tariffs and the Fed's focus. And beyond just rates, monitor broader credit conditions. Are those credit spreads we talked about widening significantly? Is it becoming noticeably harder or more expensive for businesses and consumers to borrow money?
Those labor market signals we discussed earlier remain vital too.
They really are the pulse of the real economy. Continue watching labor market health, paying especially close attention to that high-frequency data point, the weekly initial jobless claims. A sustained upward trend there is often one of the earliest reliable warning signs of trouble brewing. Also, keep an eye on the monthly payroll reports for job growth trends, and remember the SAM rule as a useful signal for confirming when a recession is likely already underway.
And consumer behavior, how people are feeling and spending.
Crucial given its weight in the economy. Monitor consumer sentiment and spending. Keep an eye on those consumer confidence indexes like the ones from the Conference Board or the University of Michigan, looking for sharp drops, especially in expectations about the future. Then see if that translates into actual behavior by watching real spending data like retail sales reports and personal consumption expenditures, PCE.
And that famous yield curve, still watch it.
Yes, the yield curve remains a historically potent signal, particularly the spread between longer term, like the 10-year Treasury, and shorter term, like the 3-month or 1-year Treasury, yields. A persistent and deep inversion continues to be a significant warning sign, according to the historical data highlighted.
Plus, it makes sense to keep up with the forecasts from the big institutions themselves.
Absolutely. It's wise to regularly review the updated global growth forecasts and any published recession probabilities coming from the IMF, the World Bank, the OECD, and major private sector banks like JP Morgan or Morgan Stanley. See how their views are evolving as new data comes in.
And finally, those big structural shifts, AI and climate.
Yes, increasingly important to monitor the progress and impacts of those major structural shifts. Track AI adoption and workforce adaptation. Look for reports on job displacement trends versus job creation, the effectiveness of reskilling programs, and how AI is impacting productivity and competition in specific sectors. And monitor climate-related events. Pay attention to the frequency, severity, and economic costs of extreme weather events, policy responses to climate risks like carbon pricing or regulations, and how climate change is impacting financial markets and insurance availability.
So the key takeaway here is it's not just about watching GDP numbers or stock market indexes in isolation anymore. It's about monitoring this diverse set of leading indicators and understanding their signals within the broader context of these powerful, interconnected structural vulnerabilities that are defining this era.
Precisely. That integrated view, looking at the confluence of signals across cyclical indicators, policy actions, and structural shifts, is the most effective way to try and make sense of this complex and likely more volatile economic environment described by the sources.
Okay, so with this outlook of slower growth and elevated volatility as the backdrop, what does this mean practically for individuals and businesses? How can they actually prepare or build resilience to navigate this period?
The core principle that comes through, both implicitly and sometimes explicitly in the strategic discussions aimed at businesses and policymakers in these reports, is the need to proactively build resilience and enhance adaptability. These are fundamental principles that individuals can also apply directly to their own financial situations.
Okay, like what specifically for individuals?
For individuals, the advice is really quite solid and practical, especially in an uncertain environment. First and foremost, boost your savings and overall liquidity. Having a strong emergency fund is absolutely critical. The standard advice is 3 to 6 months of essential living expenses, and in a more volatile environment, aiming for the higher end of that range, or even more if possible, provides a crucial buffer against potential job loss or unexpected large expenses.
That classic advice feels even more important now then.
It really is foundational.
Hmm.
Second, aggressively pay down expensive debt. Focus particularly on high-interest debt like credit cards or variable rate loans where the interest costs can fluctuate. Reducing this debt burden significantly lowers your financial vulnerability if interest rates stay high or if your income gets disrupted. It also frees up cash flow. And, importantly, try to avoid taking on significant new high-interest debt if you can help it.
Budgeting must be key here too.
Absolutely. You need to review and update your budget regularly. Understand exactly where your money is going each month. Identify discretionary expenses, the wants versus the needs that you could potentially cut back on relatively easily if you had to tighten your belt. Knowing your financial baseline is absolutely essential for making informed decisions and planning ahead.
What about people's investments? It can be scary when markets are volatile.
It definitely can be. The advice here is generally to ensure your investments are well diversified across different asset classes, stocks, bonds, maybe some real estate or alternatives, and, crucially, aligned with your individual risk tolerance and long-term financial goals. During periods of heightened volatility, making impulsive decisions based on fear like panic selling when markets are low is usually detrimental to long-term returns.
So don't panic sell.
Generally, no. If you're nearing retirement or particularly risk-averse, it might be prudent to review your portfolio allocation with a financial advisor to ensure it's still appropriate, perhaps tilting slightly towards more stable assets or those that provide income through dividends. But avoid drastic reactive changes based purely on short-term market noise.
What about career-wise? How can someone prepare on that front, especially with the AI disruption discussion?
That's a great point. The need is to stay current and adaptable in your profession. The whole AI discussion really highlights the accelerating importance of continuous learning and skill development. Keep your resume polished and your skills updated. Actively network within your industry and stay aware of the trends and changes happening.
Maybe develop a plan B.
Exactly. Consider developing side income streams if possible. This could be through freelancing, consulting in your area of expertise, taking on a part-time gig job, or even starting a small side business. Having diversified income sources provides a valuable financial buffer against potential job disruption or income volatility in your primary role.
Okay, those are some really concrete steps individuals can take to bolster their resilience. What about businesses, whether they're large corporations or small enterprises? What should they be focusing on right now, given this outlook?
Businesses, regardless of size, really need to prioritize financial strength, operational flexibility, and strategic foresight. A key recommendation is to engage in rigorous scenario planning and stress testing. Don't just create one budget based on a single expected outcome. Model different potential economic scenarios, including plausible downturns of varying severity. Develop detailed cash flow forecasts, the sources specifically mentioned, using things like 13-week cash flow projections to identify potential financial pinch points well in advance.
Controlling costs seems obvious in a potential slowdown.
It is, but it needs to be strategic, not just slashing across the board. Businesses should identify their truly critical costs and contracts versus discretionary spending. Be prepared to freeze or delay non-essential expenditures, maybe postpone major new projects, implement a temporary hiring freeze for non-critical roles, scale back on less impactful marketing spend. It's also wise to look for opportunities to negotiate more favorable terms with suppliers or even customers if conditions start to tighten.
And shoring up the balance sheet.
Absolutely crucial. Strengthen your balance sheet proactively. This means reducing debt where possible, especially variable rate debt. If possible, try to refinance maturing debt to lock in fixed rates or extend maturities before credit conditions potentially deteriorate further.
And liquidity, having cash on hand, is paramount for businesses too.
Paramount. Maintain sufficient liquidity. Businesses should aim to have a cash cushion that can comfortably cover several months of essential operating expenses under potential stress scenarios. The sources suggest that companies should run through realistic worst-case scenarios and be prepared to proactively cut fixed costs in advance of a full-blown downturn hitting, rather than waiting until it's too late.
Cutting costs in advance, like what?
This could involve things like implementing a hiring freeze early, consolidating office space if remote work allows for it, trimming non-essential travel or benefits while critically protecting core functions like research and development, R&D. They're vital for the company's long-term competitiveness and future growth. Don't cut the muscle along with the fat.
What about supply chains, given the trade fragmentation risks?
Building greater flexibility and resilience into your supply chains is essential. This might involve identifying and qualifying alternative sourcing options so you're not reliant on a single supplier or region. It could also involve more strategic inventory management, maybe holding slightly more critical inventory or using technology to get better visibility into your supply chain to anticipate disruptions.
And finally, communication.
Yes, maintain open and transparent communication with your key stakeholders, especially your lenders and investors. If business conditions start to deteriorate, providing clear, honest, and timely reporting and engaging with them early about potential challenges is absolutely key to maintaining trust and potentially securing support or negotiating forbearance if needed. Don't wait until there's a crisis.
It sounds like a lot of this advice isn't just about preparing for a potential recession next year. It's really about building a more fundamentally resilient and adaptable business overall to operate successfully in what sounds like a generally more volatile and uncertain period ahead.
That's exactly right. The core message running through the preparation advice is the best time to prepare for a downturn or just for sustained economic volatility is before it fully hits. Don't wait for the storm clouds to break.
By understanding the potential risks and the warning signals, and by proactively taking these kinds of steps now to strengthen personal and business finances and flexibility, individuals and organizations significantly increase their chances of navigating the expected volatility of this 2025-2030 period with greater stability and less disruption.
That's the goal. Informed preparation leads to resilience.
Well, this has been a truly comprehensive deep dive into a very complex outlook. Just to quickly recap the main points for everyone listening. While a deep, immediate global recession isn't the consensus baseline forecast for 2025, the entire period stretching out to 2030 is widely expected by these major institutions to be one of significant fragility and vulnerability. It's likely characterized by structurally slower economic growth than we've seen in recent decades.
And based on one key analysis we discussed, there are probable recession windows within this period. The time frame of late 2025 through mid-2027 was identified as having a moderate to high probability for a recession to occur, driven primarily by the lagged effects of past monetary tightening hitting the economy, alongside specific potential triggers like commercial real estate stress, consumer exhaustion, or geopolitical shocks.
Then there's a secondary risk window identified later in the decade, perhaps late 2028 to 2030, where the triggers might shift to be more related to those deeper structural forces really starting to bite, things like fiscal unsustainability, potential asset bubbles bursting after a period of renewed stimulus, or the disruptive economic impacts of AI adoption, climate change, and demographics becoming more acute.
And the key drivers creating this persistent state of elevated volatility and slower growth are seen as this powerful interconnected mix of forces. Increasing trade fragmentation fueled by geopolitical shifts, central banks navigating a very difficult policy tightrope with a high risk of error, the uncertain and potentially disruptive transition phase of widespread AI adoption, persistent structural headwinds from demographic shifts, particularly aging populations, and the rapidly escalating systemic risk posed by the physical impacts of climate change.
So the crucial takeaway for you, the listener, seems to be that understanding the interplay of these powerful factors and diligently monitoring a confluence of specific indicators, things like the yield curve, composite leading economic indexes, purchasing managers indexes, consumer confidence, weekly jobless claims, and credit spreads is absolutely essential for navigating this complex economic environment ahead. Proactive resilience and adaptability, both personally and in business, are paramount.
That sums it up well.
All this discussion today about a potential new normal of structurally slower growth and persistent elevated volatility, driven by these huge interconnected global forces all converging in the next few years. It leaves me with a final provocative thought for you to consider.
Okay.
If the economic landscape is fundamentally changing in these ways, if these powerful long-term structural forces are reshaping things so significantly, does the traditional idea of distinct, somewhat predictable business cycles, those neat waves of expansion and contraction we learned about, does that model still fully capture what's happening? Or perhaps, are we entering a period where economic stability itself is inherently more fragile, more susceptible to shocks from more directions? And do we need to fundamentally adapt our understanding of what it even means to be economically secure in this potentially new environment? Something to think about as you monitor the signals we've discussed today.
It certainly raises a profound question about whether the nature of economic fluctuations in the 21st century is changing. Maybe the old maps do need updating.
Definitely food for thought. Thank you so much for joining us for this deep dive into the 2025-2030 economic horizon. We really hope that unpacking these expert analyses and forecasts has provided some valuable insight and helped you cut through some of the noise out there.
Keep monitoring those key indicators we discussed, and perhaps reflect on some of the preparation steps relevant to your own situation. Being informed and prepared is always the first step towards building resilience in uncertain times.
Until next time.